Well, Happy New Year from the Love Financial Group team, and thank you for joining us today as we discuss some key takeaways from 2025 and then some market thoughts as we enter into 2026. Today, we have Paul Love with us, my dad, and Natan joining us to discuss these important topics. So, I'm going to start us off with some reflections on 2025, including some important events, macroeconomic backdrop, and the portfolio performance of our models that we manage. So, moving into the important events for 2025, the first thing that we're going to discuss today is the Fair and Reciprocal Plan, which was announced on February the 13th. So, this caused uncertainty in the market as investors tried to decipher what exactly this meant for the economy. And during this time, we saw mild volatility as many headlines came in the weeks that followed with different possible scenarios. Then we moved into Liberation Day, which was April the 2nd. This is when the tariffs went into effect. And by April the 8th, the S&P was down 19%. There was a lot of fear in the unknown of the implications to both the US and international holdings, but this proved to be short-lived, and by May the 12th, the S&P rebounded above the April 2nd numbers. Then third came the Moody's credit downgrade. The market reaction proved to be minimal, thankfully, as the downgrade was widely anticipated and did not present new information to investors. But this downgrade was caused by increased government debt, rising interest costs, and large fiscal deficits. That day, the stock futures initially fell, but the markets largely finished unchanged. And then fourth were the rate cuts by the Federal Reserve. So we have had three cuts in the last 5 months. The target rate currently is between 3.5 and 3.75%. The markets had somewhat factored these in before they were officially announced. So these cuts helped boost the overall performance of the S&P as they were already factored in. Some other key takeaways in 2025 were the AI arms race between the Magnificent Seven hyperscalers. So, as most of you on this call already know, this is a high stakes competition to achieve dominance in the artificial intelligence, primarily driven by massive capital expenditures on infrastructure, chip development, and the integration of AI into their core business models. We have had a lot of clients call in with questions this year on our own exposure within our models to AI and infrastructure, which tells us that people are beginning to see AI as something that's here to stay and a long-term change. Another big topic in 2025 was cryptocurrency versus real assets and rare materials. So, one big question in this space is, will cryptocurrency replace or make a dent in printed money? There are a lot of areas in this space that need regulation, and there's much discussion on what this will look like in the future, in 2026 and beyond. And another key takeaway was current valuations in comparisons to previous market downturns. So as we ended 2025, you probably heard headlines about high market valuations and uncertainty if those valuations could be sustained going into 2026. We will see opportunities going into this year, and we will go more in depth in this later in the presentation. So I'm going to take us into ranking of our portfolio performances. These are the portfolios that we manage or that we have clients in. And we're going to discuss the ranking of them and then kind of some changes that we made in our tactical model. So our number one performer for 2025 was Dogs of the Dow. It did not start off the year like that, but ended very strong. Number two was capital wealth, enhanced dividend income, or our covered call strategy, as we like to call it sometimes. That's what they do in that model. Third was the American Funds growth and income. Fourth is the O'Shaughnessy trending value, which if you were invested in that model, you saw a little bit of volatility throughout the year, but it ended much higher than it started. Number five is our guided equity, and number six is our dual momentum. So I would like to point out that this ranking is the entire fiscal year of 2025. So starts on January the 1st and ends on December the 31st. As the year went on in our dual momentum portfolios, we moved more into the international space and transitioned from growth into value towards the end of the year. We also saw opportunities in technology and innovation sector funds. The equity markets did not follow normal performance trends in 2025, but we continued to find opportunities for growth and diversification. For the dual momentum strategy, this is the one that we rebalance monthly. This is our tactical model, and we will go into cash alternatives when our indicators turn negative. So it has a little bit kind of a safety net built into it. So when we were looking at the ranking of these portfolios, it wasn't a surprise to see this one a little bit lower because it has that built into it. We will be rebalancing Dogs of the Dow, American Funds, O'Shaughnessy, and our dual momentum this month. So be on the lookout for those changes. Next, I'm going to pass it off to my dad.
Hello and happy New Year to all of you. On this slide, we're going to discuss our process for managing portfolios, which has evolved over time from more of a singular person to a team process using the models I have developed over the years. While anyone in our portfolios receive notices of position changes, they may not know how we decide on those changes. So we use a team process. We have weekly meetings to discuss markets and portfolio performance. Monthly, usually towards the end of the month, we meet to discuss changes to our dual momentum portfolios and recommendations to our 401k advisory service subscribers. Prior to our monthly investment meetings, each team member independently runs the same models Paul, myself, has built over the years and makes their recommendations, all three, which are then discussed. To give you an idea of what we did at the end of December, after considering 2025 performance, potential volatility, past returns of midterm election years, current market valuations, seasonal weakness of January and February, and the current state of the U.S. economy, we made the following changes in our dual momentum portfolios. We lowered our allocations to growth equities. We increased our value positions. We maintained our international positions, and we slightly increased our cash equivalent positions in anticipation of higher volatility.
Thank you, Mr. Love. Now I'll take us into where we are in the economy now and what we're looking at going into next year. So first, I want to mention the Federal Reserve has a dual mandate requiring them to conduct monetary policy to achieve maximum employment and inflation, which means long-term averages for unemployment rate of around 4% and inflation of around 2%. So first, when talking about unemployment, unemployment rate trickled down to 4.4% in December, but it's still the highest rate that we've had since October of 2021 during COVID, and it's slowly rising. On the other hand, labor force participation rate, which is defined as the percent of adults actively working or recently laid off and looking for a new job within the last 4 weeks, that is slightly declining. So those moving opposite directions could mean that rising unemployment is leading to discouraged job applicants who stop searching, retire, or go back to school as alternatives. And as you can see in the bottom left here in this Wall Street Journal article, US Bank chief economist Ann Bovino puts it perfectly. She says, quote, "We are at an inflection point," and describes that a lot of companies that hired a lot of graduates after COVID are now conducting layoffs, and there's an overall cooling of the job market that you can definitely see. On the other hand, the second part of the dual mandate is inflation, which as of right now is relatively sticky and above the long-term 2% goal. The Federal Reserve tracks inflation through PCE, or personal consumption expenditure, which is 2.8%. Unfortunately, because of the government shutdown, that data was released in September, and we haven't gotten another release since, but it's still, a piece of the puzzle that we're definitely looking at and hoping that we will get another release either later this month or in February. But the other part of inflation is CPI, which is Consumer Price Index. This is a report independent of PCE. It's published by the BEA, or Bureau of Economic Analysis, and excluding volatile food and energy groups, it was 2.6%, which is exactly the same that was in November and was exactly in line with expectations. So November CPI was a report that surprised a lot of people, and stocks definitely jumped on that day. But that report was only based on 3 out of 21 possible data points. So investors were definitely looking at this December report that came out yesterday, and it came in line, exactly in line with expectations. So next, I'm gonna discuss the actual, Federal Reserve moves that were made. So they have two ways of influencing monetary policy. They can influence short-term rates, which are rate cuts in the federal funds rate. There were 3 rate cuts of 25 basis points in 2025, like Elizabeth mentioned. They were in the September, October, and December meetings. So in the last 5 months, and those were back-to-back-to-back meetings. As of right now, there's a 7.2% chance that rates are the same 1 year from now, after the January 27th, 2027 meeting. And on top of that, both candidates with the highest likelihood of being elected the Fed chair in May want more cuts and are supportive of lower rates. So on the other hand, to influence long-term rates, the Federal Reserve can either do quantitative tightening or quantitative easing. And since 2022, the Fed has conducted the largest quantitative tightening program in US history. And starting in December, until further notice, they will only repurchase short-term assets like government T-bills to maintain current balance sheet levels. So just from a 30,000-foot view, quantitative tightening, less money gets injected into the money supply, less dollars are circulating, less liquidity, and the economy cools. And on the other hand, quantitative easing is when money is injected into the money supply, increases liquidity in markets, and the economy heats up. And this is often used in times of low growth. So the United States has been doing quantitative tightening since 2022 to combat those inflation hikes that happened after COVID, and just recently stopped that to influence long-term rates as well. So they're definitely making moves. And now we're going to go into our market outlook for 2026. We're going to cover the current climate, what a K-shaped economy is, and Mag 7 performance. So first, the current climate. If you've heard the news in the last, honestly, couple of years, you've heard about AI, you heard about the boom, you've heard about, all you hear about is growth about AI, and we believe these companies will continue to grow, but at the same time, we believe there's additional headwinds to consider coming into 2026. So first, AI spending is accelerating, but there are some concerns that share prices are inflated because companies like NVIDIA, OpenAI, and Oracle invest in each other through capital expenditures. For example, in May 2025, Oracle announced plans to buy $40 billion worth of NVIDIA chips, or yes, exactly. No, no, oh, In May 2025, Oracle announced a $40 billion investment in NVIDIA. 4 months later, NVIDIA agreed to invest $100 billion into OpenAI. And that same month, OpenAI agreed to pay Oracle $300 billion over 5 years for cloud computing services starting in 2027. So the big question that we think will determine long-term success is the added productivity with AI resulting in revenue increases or cost decreases through job cuts and mass layoffs? Midterm election years also is another headwind that we're paying attention to. They're historically more volatile and they have lower returns, especially for growth stocks. We personally keep track of 48 years of data, and we have returns for every single month. And that data shows those returns in every month of midterm election years, in particular, are lower than in the other 3 years of an election cycle. So we have 48 years of data, we have 12 years of midterm election data, but the difference is enough to at least note. So on the other hand, there's definitely a lot of tailwinds that we see at the same time heading into next or this year. The first of which obviously being growth prospects for tech stocks are still higher than any other sector, and they're continuing to grow, albeit incrementally. Also, income tax cuts and incentives from the One Big Beautiful Bill Act that go into effect this year and may stimulate lower income consumption and therefore economic growth. These could be, permanent tax rates and increased data deductions, temporary senior citizen deductions through 2028, and also other incentives like deductions for interest on car loans, no tax on tips or overtime, or, the increased child tax credit. On top of that, the current Federal Reserve Board is acting independently under Chairman Powell, and rate cut decisions so far have been methodical and data driven. On the or as On top of that, there's potential for another technological renaissance if these AI companies are able to continue growth and increase profitability like they have been the last few years. And overall, in aggregate, companies are just more cash rich and they have less debt than ever before. Unlike the dot-com bubble in 2000, these AI and semiconductor companies are real revenue generating machines, and they've proven their ability to consistently grow their earnings the last few years. So now we're going to go a little bit into the K-shaped economy. And if you've heard about that, it's been all over the news. We've heard about it in every webinar we've been to, but we can't cover that without first covering GDP just a little bit. So over 70% of GDP is consumer spending, meaning consumers actually being able to purchase goods and services is paramount for the growth of the economy. So this has become more difficult since COVID, as inflation has steadily been above long-term averages, wage growth has decelerated, and unemployment continues to rise. This is all causing average household debt to rise. And while inflation remains above long-term averages, the Federal Reserve warns that downside risks to unemployment rose in recent months and cut rates to combat a potentially cooling labor market, kind of implying that this is more of a focal point over inflation as of right now. So the big question that we're asking is, can the economy grow as lower income consumers keep facing rising inflation, slowing job growth, and decelerating wage growth, and on the back of higher income consumers? So what is a K-shaped economy? As you see in the bottom left, it's a term for the divergence of purchasing power between higher and lower income consumers following an economic recession. Simply put, after COVID, higher earners have been able to rebound much quicker and easier than lower income consumers. The magic number, the line that is considered the divergence for the K, is an income of 150,000. So high income consumers are over that, and low income consumers are considered under that. So with that being said, rising costs are disproportionately affecting those lower income households, while those high earners experience much slower loss of purchasing power and wage growth. Finally, rate cuts do lower the cost of lending and increase purchasing power, because consumers, have more money to spend and can take out loans at lower rates. But The caveat is even though lower end consumers may be able to afford more, the marginal growth in purchasing power is coming from debt financing and not wage growth, which has been decelerating for a few years. So now going a little bit more into the actual companies that or how we're looking at a company, going into the future and into this year. Um, when taking a deeper dive into some of these companies within the S&P 500, we do see some nuance and opportunities for growth outside of the Magnificent Seven going into this year. So according to theory and research, share price in the long term is directly correlated to a company's earnings growth. And earnings per share, or EPS, is the metric that's used to quantify that earnings growth. By definition, EPS is earnings divided by shares outstanding, which is the amount of shares on the market available for purchase, which will be important for later. So the Magnificent Seven, or the Mag 7, is projected to continue their dominance in EPS growth, but the S&P 493 or the other companies in the S&P 500 are forecasted to grow at a much, much faster pace in 2026. Only two of the top 5 companies with the highest projected EPS growth in the S&P 500 are actually Mag 7. So we see a lot of tailwinds for these S&P 493 companies and a lot of opportunities as well. Specifically, the Mag 7 has forecasted EPS growth of 22.7% in 2026, the highest out of any sector, but it's only marginally larger than their 22.3% growth rate that they had last year. So growth is still extremely high, but it's kind of decelerating just a little bit. So what we're looking at is the S&P 493, which has forecasted EPS growth of 12.5% in 2026, which is 30% higher than their growth rate in 2025 of 9.4%. So we are trying to look outside of the Mag 7, and we understand that although, AI is the hot topic, and a lot of these companies have been generating a ridiculous amount of revenue and earnings, there are opportunities outside of the Mag 7 as well. Going a little bit more in depth about that kind of split between the Mag 7 and the rest of the S&P 500, the CapEx circularity that I mentioned, that comes when companies invest in each other, combined with large share buyback programs by those Mag 7 companies, which can artificially boost EPS because when these companies buy back shares, it reduces the denominator of EPS and boosts earnings per share. So investors have definitely pulled that into question, and are curious if earnings are being inflated. But that's obviously speculation, and we don't know that yet. So on the other hand, there's currently not enough power to run all the data centers that are forecasted to be built in the next 5 to 10 years as well. And within that, nuclear power is the only real and feasible way to power all the new data centers that are forecasted. But unfortunately, nuclear projects take longer than other sources of energy to actually complete because of regulations and negative perceptions by the public. So for these reasons, we believe certain other sectors may have become undervalued and almost forgotten as investors have favored AI stocks. So we believe growth in 2026 might be a little bit more diversified. And as I mentioned on my last slide, only two of the top 5 companies projected to have the highest EPS growth in the S&P 500 are in the Magnificent Seven. So this implies tailwinds for S&P 493 companies that are figuratively selling shovels during a gold rush. These can be chip makers or semiconductor manufacturers or also industrials.
Thank you, Natan. Now Paul is going to close us out with some of our initiatives for 2026. Paul, you're muted.
Okay. Just like most major companies, at the beginning of the year, we set our goals and objectives for the new year. We believe this is crucial in delivering the best services and growing our firm. As such, we've outlined our team objectives and responsibilities for 2026. For Natan, he's going to use a lot of our tools that we have worked and refined and studied over the years. He's going to test new investment strategies for possible inclusion in our portfolio offerings. Also, we always try to refine and implement different tools that we use. One of those is eMoney's estate planning tools. That is typically when people are looking to pass on to the next generation things, estates. It's a very good thing to draw a picture. While we can all understand verbiage and maybe wills, but actually seeing this drawn out in a picture is very helpful. Elizabeth is going to continue managing the LFG office. We've put a few more, I guess, duties on her shoulders, which she absolutely loves. And we're going to review our processes for increases in efficiencies and increased usage of AI tools. I'm going to continue to build out our LFG social media presence, and she will continue to mentor Natan on Black Diamond, our trading platform. For myself, I will continue mentoring the team on investments, taxes, and estate planning. And if we hit all these objectives and make progress throughout the year, we look forward to being a better firm, size-wise and service-wise, by the end of 2026.
That's right. Well, thank you for joining us today. We hope that you found this information helpful and informative. As always, if you have any questions, please feel free to reach out. We are here to help in any way that we can. In closing, I do want to let you know that we did launch our YouTube channel about 2 weeks ago. So you can go to YouTube and type in Love Financial Group, and you will find our first video on there. And we are going to be putting those out monthly. So stay tuned. And our podcast will be launching soon as well. We do have our women's event coming up on February the 12th. We have our Q1 birthday luncheon on February the 24th. And our 5th annual bowling event is April the 16th. So a way to celebrate after the tax deadline. You can come out and bowl with us, or you can just come and enjoy the company, good food, and some music. So it's always a fun time, and we hope to see you there. Thank you again for joining us, and take care.